maybe allow, like, you'd see some sort of secondary market open up for these longer term bonds, and having a very traditional bond market in DeFi where, users can converge on some price in a secondary market. Anyways, that's a very interesting thing to think about, and a very key point is the tokenization in terms of what can be built on top of Bond.
Yeah, I totally agree. And one of the interesting things since we last spoke on the Big Red podcast, the Uni V4 paper came out. And I know a lot of people have been talking about their singleton contract where they use ERC 1155. It's really, really interesting because that's exactly what we use for the fixed term bonds. And it's kind of funny, a lot of what people have been describing, the benefits of ERC 1155s, as well as why we use it, is the reason why Uni V4 is using it for their singleton model.
Right. Wow. Cool. Yeah, I was looking at Uni V4 like last night. Oh, that's cool. I didn't know that. Yeah, well, Bond's ahead of the curve, y'all.
Let's go.
Okay. Yeah, let's go. Okay, so just to recap, we've got fixed term, we've got fixed expiry. I believe all of the markets, all the live markets right now are fixed term, which means people in the audience, if you want to buy a token that the protocol is offering, you can buy it at a discount, and then you've got this set term. So there'll be like 21-day term, 7-day term. And in terms of Oath, there's an earn and Oath market as well, which is a 7-day term. So you wait for these tokens to be at a discount, you buy them, you wait 7 days, and then you get your tokens released. Now, the discount is dictated by the Dutch auction system. So do you want to just describe Dutch auctions and what sequential Dutch auctions are?
Yeah, Dutch auctions are in contrast to English auctions, where I think a lot of people are familiar with the concept of, bidding wars, where people just, raise their paddle and the price goes up. This is a bit expensive in the context of blockchains, where if you were needing to execute a transaction and pay for gas each time only to lose at the end, this would still just be a very poor experience all around for English style auctions. For Dutch auctions, it actually starts at a high price and then goes down. And so if you can think about a bond on Bond protocol for a given governance token that has some arbitrary vesting period, you can think of it as starting at the market price. Like whatever the market price it's trading at, it starts there, and there should be some price for illiquidity for needing to actually wait during the vesting period to unlock the underlying governance tokens. So the price just decreases from there. And whenever someone kind of makes the decision that this is an acceptable discount to actually in compensation for the vesting term, then they purchase at that discount rate, at which point the price pushes back up and then the cycle starts over.
Right. And if any of you are on the D app right now, the visualization, if you click on any of the markets, will help out a lot, because it's kind of like this spiky chart where you can see the price going down, someone makes a purchase, and then it resets. And so that's why there's sequential, is because like it's just a one Dutch auction after another. And some people will get bigger discounts than others. I saw on the Oath market at like, it got down to like a 15% discount, and I was like, oh, I should buy this. And then I like made dinner or something, and then someone had scooped it, and I was like, no. Yeah, but it's cool because
it's always interesting seeing how people, price it and kind of waiting for it to get lower only to have someone snatch it.
Yeah, it's a bit of a there's some game theory involved, and it kind of reminds me of like LBPs, where you can buy or sell, because like everybody just kind of waits for the first person to buy, and then it's kind of, I don't know, it's it's a cool kind of game that goes on. Okay, cool. So those are Dutch auctions. Those are the types of bonds offered. So I kind of want to shift to the deployer side of things and talk about why protocols would want to create a bond market like this. So, you know, what are protocols trying to achieve? What are the key points of why a protocol would want to do this? Who does it benefit mainly? And what are the benefits on the other side on the protocol's perspective?
From the protocol's perspective, if you look at most protocols in DeFi and in crypto right now, they're sitting on a large war chest of tokens, but most of the value is in their native governance token. And actually, if you look at the quantities of these tokens, it oftentimes vastly outnumbers the amount of available liquidity. And so I think from a protocol's perspective, the idea to take some of these tokens and sell directly into your own liquidity pools, which oftentimes the protocol is incentivizing as well, just seems like a really poor decision to make. And if there is some governance proposal put forward to actually do this, people will front run the massive incoming sales. And so what you're trying to select for is, are there people in your community who would be willing to take on this duration risk for some vesting period to essentially acquire these tokens at a discount? And so there's a set of community members who would be more willing to actually purchase at a discount in exchange for some vesting period, more so than a random person who just sees the discount and decides to do some time arbitrage. And generally, you want to select for people who have long-term alignment with protocol. And so even though you are having some amount of tokens that are issued at a discount and it's less than what the market value might suggest, you're hoping to select for a group of people who aren't just turning around and flipping the discounts into the liquidity pools. And at the same time, you're actually splitting up the amount of tokens which are being issued over time. So looking at a lot of analytics sites for different protocols, you generally see emissions curves. And it's not really the best idea to have large quantities just emitted all at once. And so that's the other side effect and benefit of this sequential Dutch auction model, is you can take a very large number of tokens and split them out into a smaller number over time, and actually over very long time periods, as some of our long-standing partners are doing.
Yeah. And I was actually thinking about TWAMs today, and how it's kind of similar, like time-weighted average market makers, or time-weighted automated, I don't know, one of the two. But like, it's kind of a way to sort of, for a protocol, raise money sort of over time, but also for maybe a big whale or some individual could theoretically deploy their own market and sort of slowly exit a position over time, which just kind of reminds me of there's a lot of similarities with like AMMs and the bond protocol primitive. Anyways, kind of a weird tangent, but
no, I mean, that's a great tangent in the light of Uni v4 having a TWAM hook built into it.
Hmm.
Essentially, like this idea that we mentioned of taking a large quantity of tokens and splitting it into, a certain number of chunks per Dutch auction. The TWAM idea was first published by Paradigm, and they also published another version called, gradual Dutch auctions, which is, I think, it's very similar to what we're up to, except in both of these examples, they use some pretty complex math to actually split those tokens into an infinite number of chunks.
Yeah. Oh my
And
God.
and that's a little bit in contrast to what we're doing. We split it into, a certain number of chunks. This is the max payout that people can receive from a bond market. With Paradigm's gradual Dutch auction or GDA approach versus our sequential Dutch auction approach, when they split it into infinitely many chunks, there is actually like some element of slippage, like a regular AMM trade that comes into it. But I think the UX for that is kind of interesting, and I know some people who are working on that in the space. So will be kind of interesting to see how that plays out over time as well.
Yeah, that's cool. I'm definitely going to look at that directly after this. That's really cool. Yeah, and on the topic of financing for protocols, I was reading maybe I'll drop this in the chat as well. But I was reading the case study on JPEG, and I don't know, this is a very tangible example of a DAO having to raise money, wanting to boost their liquidity, specifically on Curve. And I think this was last year sometime, right? Was it last year?
Yeah.
Anyways,
and earlier this year.
Right. Yeah. So they were able to raise almost $1 million through the bonds on Bond Protocol, and now they're one of the biggest holders of CVX, and they're just doing really well. But here, I'm going to drop that case study in the chat because it's a good one to read. Okay. While I do that, what did I want to ask you?
I think just one small comment there as well is we talked about like payout token and quote tokens. So in a lot of cases where protocols are issuing, oath, for example, then you're actually getting it's quoted in ERN. And a lot of times people go with ETH or stables, but the really cool thing with the JPEG use case is that it was JPEG quoted in CVX. And so they just directly acquired this strategic asset and like, which is very, very important for the liquidity of their stablecoin. And yeah, it was just a really great case study and shows that you can really configure these bond markets for any type of asset that a protocol wants to acquire.
Yeah. Very, very tailorable, if that's a word. But yeah, just really, really cool primitive. So I would like to know what you are personally excited about in terms of the growth of Bond Protocol, or maybe the the side quests, so to speak, that might come from other protocols building on top. Like, what are you excited about to see moving forward with the primitive that you guys have built here? And what? Yeah. I guess I'll stop it there.
I think what I'm really excited about is people exploring more basically integrated solutions with bonds. We have a function in our smart contracts that allows anyone who hooks into a bond program and runs a front end for it to actually charge a referral fee. And I think this will be really interesting as, maybe DEXs, launch pads, actually integrate bonds into their own front end. on behalf of other protocols that they work with. And so we're really hoping to kind of spread the word of this decentralized front end fee, which we configured like Liquidity, and definitely looking forward to some catalysts that will drive adoption there soon.
Very cool. Yeah, that's very cool. Yeah, go ahead.
We do also have another side quest that we'll be making public probably next week, but I figure this might be, fun time for some alpha. But have you seen any of the option token liquidity mining projects recently?
Oh my God. I don't think so. Tell me about them.
Yeah, so essentially this is building on an idea that Andre Cronje had in late 2021 of using option tokens as liquidity mining incentives. And if you just look at normal pool 2 incentives or people giving out, farmers on their platforms, their native governance token, you can think of it as giving them a call option with a strike price of 0. They're just getting it for free. So he actually implemented this O token model at Keeper Network, and interestingly, also ran a bond program with us at Olympus Pro for Keeper Network. And I think the bond program actually allowed them to acquire much more liquidity much quicker at that particular time, because this was peak bull market. But the O token model is really interesting because you can take, some subset of option tokens and incentivize liquidity with them. And generally, this also comes with the benefit of having a multiplier effect, since more people will deposit into a farm, whereas bonding is a kind of like one-to-one exchange at a moment in time. So bonding is really, really great for a certain set of use cases where you're looking to build up, a treasury over time. But if you're looking to get a one-off multiplier effect while also kind of getting a smaller amount over time, O tokens are very useful for that. So we're actually coming out with an O token as a service product very soon.
Whoa.
You heard it here, folks.
Whoa. Oh my God. Alpha. Oh, geez. Wow, that's really cool. You kind of blew my mind. Wow. Sorry. I'm just thinking about so many things now. Holy crap. Well, I would like to, I'm going to be keeping up with that and reading any documentation you guys put out on that, because that's a really cool idea. And yeah, that makes so much sense to me. When I hear ideas like that, it's kind of, you kind of have a moment of oh, well, obviously that could be a thing. It just makes a lot of sense off the bat. But that's really cool. And in terms of, okay, I was going to ask about the permissionlessness of bond protocol. And I think right now it's permissioned. So you need to basically, if a protocol or some other team wants to deploy a market, they need to go through you guys. But
so actually now, that actually changed since the last time we talked.
Oh my God, awesome.
Yeah, so now it's fully permissionless. And basically what helped unlock this for us was just utilizing CoinGecko and DeFi Llama under the hood. DeFi Llama has a really great infrastructure for querying LP token prices. And they also plug into CoinGecko for, getting the price of different governance tokens. And so basically, instead of, pointing us in a, now sunset repo on GitHub, like where the governance token that you want to issue is, like what the contract address is. All of that exists on CoinGecko. And so provided that a given token is listed on CoinGecko, you can just plug that in into the interface right now, issue a bond market, and this will work for, you know, protocols or even individuals. It's now completely permissionless.
Wow, awesome. That's cool. And are you planning to go through some similar process in terms of the options bonds? What do I call them? The options incentives?
I think we're calling it O token liquidity mining.
Okay.
So just O tokens. So since O tokens are much more integrated in what a protocol actually wants to be incentivizing their users to deposit into, I think the front end interface will be a bit more on like inside of a partner's DApp. So this will be less of a thing on our side, where this is much more of an infrastructure play, but the contracts themselves will be also completely permissionless. People can deploy and wrap O tokens however they want to.
That's awesome. Oh my God, this is all very exciting. Yeah, okay. So let's talk a little bit about maybe a little bit more about the benefits of having protocol and liquidity, because I don't know, I've seen a lot of users or questions about, why are you selling the token at a discount? People are just going to buy it and dump it, or questions along that vein. And I mean, it seems a bit obvious, but like right now in this kind of market, having a treasury of diversified assets, or having a treasury of, like in the JPEG example, having a bunch of CVX, it can be a way to generate a lot more revenue, and also like fill your liquidity pools with liquidity that's not going anywhere. Like there's no capital flight risk involved when you plug a bunch of POL into a pool. So yeah, I kind of just answered my own question, but do you have any thoughts about POL and like all the benefits there? And
I think you covered a lot of the benefits in terms of having some always on liquidity for a given project. And then the other thing as well is, at least personally, I've not had much success with liquidity mining. Generally, like unless you catch the price swings at the right time, the actual dilutive nature of protocols issuing governance tokens to incentivize liquidity for those same governance tokens, it has kind of this really large risk of people just kind of claiming those incentives and then dumping them, and claiming and dumping. And as more people are selling these tokens, more people pull their liquidity. And so with protocol owned liquidity, and we've seen a couple examples of this, Olympus DAO being kind of, I think, the most widely known example, but I want to say it was something like 40, upwards of 40, like between 40 and $50 million that Olympus earned on owning its own liquidity. And a lot of that has to do with just it's, a very long-term protocol, and protocol and liquidity is meant to always be there. And so you can actually, from the protocol perspective, hold that liquidity for long durations of time. And there were some old analytics reports, I want to say it was in Nansen, where it showed that if you held an LP position for, somewhere between 200 and 300 days, maybe it was 250 days, fees would generally offset IL or mean reversion on the token price. Protocols can make this assurance much more than their communities can. So I think generally the way that I would like to see DeFi moving over time is having some base chunk and a large chunk of protocol and liquidity, and then community members or traders can actually build more concentrated liquidity profiles on top of it. So the protocol has like a Uniswap V2 0 to infinity range, and then people are actually concentrating their liquidity because they're much more. I think that makes the actual bet that people are making much clearer than with liquidity mining.
Yeah. There's definitely a reason that Olympus is still around, and I don't know, I hate when they, I don't know, like their primitives that they built get kind of linked to Ohm and like the tokenomics with Ohm, because like Olympus Pro is such a good product, and what you guys have built is like such a good product and such like I don't know, it feels like such a strong building block, and not just sort of some new, shiny toy to like spin up and build a bunch of TVL and then just like you give a bunch of incentives out, spray incentives everywhere, and then your token dumps and then it goes away. It's just I really like the Olympus Pro model, and that like building a diversified treasury, a large diversified treasury, gives protocols so much more like flexibility in terms of what they can offer their users, and like you mentioned.
Yeah, and I mean, part of the reason why Olympus DAO is still around is because of this bonding model. I mean, that's how they acquired, I think it's around $200 million still in Olympus's treasury. And so this mechanism basically allows other protocols to harness this same sequential Dutch auction model to essentially, it's like a form of treasury management where you can acquire assets that that is valuable long term for the protocol, like ERN, like CVX. I mean, especially when the assets that a protocol is acquiring actually have some fundamental utility or are intrinsically linked with the protocol. These are just really good examples of a flywheel that you can kick off instead of just attracting people with temporary inflationary incentives, like a Terra model with UST. It's like, hey, 20%, where's it coming from? These VCs.
Yeah.
So it's very much not the type of model that is sustainable in the long run when you're just paying out incentives. But when you're able to put a treasury to work for the protocol and acquire strategic assets, that's kind of the type of financing that we help unlock. And just really, really excited to see more people use these mechanisms to bolster their treasuries and acquire strategic assets.
Yeah, me too. And the O token thing is very, very exciting. O token liquidity mining, I'm going to say it over and over again, is very exciting because I like right now the game is farm tokens and dump them, and like those are the people that win. And it's like the incentives are skewed in the wrong direction. It's like the way you win the game is by being mercenary liquidity, which I can't blame people for doing, because that's kind of how you make money. And it's like that is like one of the biggest barriers to entry, in my opinion, for people trying to get into DeFi. It's like, oh, you have to be a shark essentially.
Yeah, and I think people get wrecked because they look at, yield farming and are like, oh, I can do that. And then they just set it and forget it and come back later. you know.
I'm like having like PTSD from my early days.
Yeah, and you think that that's the winning strategy, but the winning strategy is actually to be very mercenary. And so I think like with option token and O token liquidity mining, it's already like a conceptual gap where it kind of just by nature of being slightly more complex, it narrows the game down to people who are a bit more mercenary anyways. And then, if you actually have the strike price for the option set at, maybe like, 20-30% discount, but you're also getting that liquidity in return. At the end of the day, you're not giving tokens away for free. The protocol is acquiring something in exchange, as well as that temporary liquidity boost. So there's a lot of ways where it's much more sustainable than, traditional liquidity mining incentives.
Yeah, 100%. Yeah. Okay. Well, we've covered most of what I had. I did want to just sort of complete the circle and do a bit of recapping for anyone who might have joined late or users trying to tie this into what they can do. So, guys, you can buy tokens at a discount on Bond protocol, and you can support the protocols offering these markets. And you guys are on, you're on Optimism, you're on Mainnet, and you're on Arbitrum as well, right?
Yes, that's correct.
Perfect. The big three. And there is no Bond token as well. I'm not quite sure what you would do with that, but yeah, I was going to ask: are you planning to offer any token? Is that something that makes sense at all? Yeah. Okay,
no token for now. I mean, it's exactly like what would you do with it? Just stare at it and admire it. But yeah,
exactly. You know what? I would do that. Sometimes I open up my portfolio and I'm like, oh, they're so beautiful. Look at these little tokens. Look at these tokens losing
Bond
money.
NFTs.
Yeah, dude. When Bond like secondary markets.
That's a big one.
Yeah, and even like bonds as collateral, all this kind of stuff is just cool things to look forward to. Was there something that you wanted to cover that I haven't mentioned? I'm sure I might be forgetting something, but
I think we covered a lot of it. I'll drop a link here to a thread that we put out today. But it's basically a series of articles that we wrote about configuring bond markets, how to prepare a bond market, like what should you be looking at, and like from a protocol perspective, and then as well as analyzing the performance afterwards and monitoring it. So I'll drop this thread here. And it was today, this 3-part series. So I think this is a really great one for people to check out. It goes a bit more in depth on some of the topics that we covered here today. And also check out the bond markets. It's bondprotocol.finance, and follow us on Twitter at @bond_protocol.
Hell yeah. Nice. Yeah, guys, read the docs also. I think I say that every single day to somebody, but read the docs. They have very, very clear and understandable docs. And learn about bonds. I mean, even if you're going the TradFi route, bond TradFi route, it's the same. They're the same principles. And bonds are one of the foundations of any financial industry. So bond knowledge is very, very useful and very a very good thing to learn about. So I encourage you to start your bond journey if you haven't, and start it with Bond Protocol. Wow, that was such a good ad. Oh my god. Should make
gonna cut that audio sample there.
Nice. Yeah, I expect compensation.
I'll pay you in a bond NFT.
Yeah, nice. Oh my god, I would love that. Okay, awesome. Thank you for coming, Tex, and thank you for everybody who listened in the audience. Yeah, check out Bond Protocol, join their Discord. Let's keep the discussion rolling. And we have a recording that we'll post somewhere as well of this. And we can send it over to your Discord if you guys are curious or if you're interested.
Yeah, that would be great.
Sweet. Awesome. Yeah, thank you. Thank you, Tex. Another great discussion. Thank you, everybody, for coming. And catch you later.
Thanks, y'all. Thanks for having me.
Cheers. Hell yeah, good talk. Love that.